We now have Mark Stevens, who's one of the external investment advisors to the pension fund, and he's going to go through some of that investment stuff in detail. Mark, over to you.
Uh, thank you, Chairman. Yes, indeed. I am going to go through some of these topics, particularly on the investment side, in just a little bit more detail. So, the topics I'm going to try and go through quickly this afternoon, I displayed on the screen there. Essentially, the investment backdrop of what we've all experienced over the last fiscal year. I'm going to look at the evolution of the fund value, some of which we've seen, but I'm going to bring you up to date with some slightly more up to date figures as well. I'm going to see how the asset allocation of the various assets within the fund have changed over that period. As I always do, I'm going to look at fund performance over both the short term but over the long term, which is obviously much more meaningful. I'm going to finish off with two topics. One is some observations on the fund performance and the future direction of asset allocation, which you might find of interest. And then finally, I'm going to make an attempt to try and bring some thoughts to what they think the investment panel is going to be doing over the current financial year. So if we can start, that'd be good. So just in terms of the backdrop, I don't think it would be much of a surprise to anyone who's lived through this last year and a bit to see that we're in pretty unprecedented times in terms of the way that the COVID pandemic spread through the world very, very fast. And certainly when we came to the beginning of the financial year, I would say that most of the world's economies had some degree of lockdown, and a lot of them a lot of economies had essentially hit a brick wall. But the response was extraordinarily fast. We had in total something like $12 trillion worth of support from central banks across the globe in terms of various types of monetary and fiscal support. And it was really unprecedented in terms of its speed. And I think a lot of it was to do with essentially, we'd had a dress rehearsal to a certain extent of a catastrophe in 2008. And it was that dress rehearsal in terms of the great financial crisis that allowed essentially the central banks to have a ready-made playbook as to how to respond, and they did respond extraordinarily well. What was expected to be the deepest recession since the 1930s was very severe, but it bounced back very, very quickly. So we can see here that global equity markets actually recovered very, very strongly post the financial year end, and actually had gained back almost all their losses by August, which was quite extraordinary. But gaining about 40% over the fiscal year in GDP terms, sterling terms. Not only that, that recovery that we saw during the back end of last year even gained momentum, because as the first vaccine approvals were approved in November, we saw a whole lot of other companies begin to start to perform. And as the world economy began to gradually unlock, momentum was maintained. Against the backdrop of all this, of course, is that the EU and the UK finally departed close company at the beginning of that year. It's sometimes lost with all the other things going on. But we in this country had the benefit of sterling finally coming out under that cloud. And over the period, sterling actually performed quite well. Just as the financial year was ending, so I'm now talking about the first 3 months of this year, 2021, some other things were beginning to take shape. So equity markets were continuing to perform. And that cyclical recovery I mentioned was gaining momentum. But what was also happening is we were seeing the first seeds of inflation. Now, inflation is something which I think is probably going to be close to all our hearts in the next little while, but we've all been noticing it. But we've had disrupted supply chains, we've got labour shortages, we've got energy costs going up. Some of these are directly a response to coming out of a pandemic. Some of them are maybe a little bit more deep rooted. And markets began to get a bit concerned about this inflation. And certainly for a while, some bond markets began to experience some sort of volatility. I suppose against the backdrop of this was also, if you remember, the emergence of the Delta variant, the very, very highly contagious variant of COVID. I think it gave markets some concern that there may be some others around the corner, and all the progress we've made will be in some form of setback. But so I think that's the background, a very, very complex, and as the chairman has mentioned, highly volatile year in which the investment panel made their decisions. Next slide, please. So we're going to look at the evolution of what actually happened during that period. I've explained it was a very interesting period, but this is what's actually happened. So thank you. So as we've seen, we ended the previous financial year at about 13.1 billion, because we were really in the heart of the market sell-off, and things were looking very, very difficult indeed. Since that period of time, we've had the recovery, and this is up to March. Tremendous amount of support from various central banks, but with the help of vaccine and unlocking, markets have recovered very strongly. And as mentioned by Rodney, as we ended this fiscal year, the fund had recovered up to just over 16 billion, with the vast majority of that coming from market returns. Next slide, please. So what's that done to the assets? Well, I don't think there's really much complexity here to be unraveled. We have simply had the most extraordinary returns from equities. A number of the asset classes have performed less well, but most of them have been just about okay. But you can see that big change between the 2 years in terms of the percentage of assets in the fund. It's all come up to a big rise in equities. And that is simply a reflection of that extraordinary recovery we have seen. So as the financial year ended, we had 67% of the fund in UK equities, sorry, in global equities, and we had 14.7% in bonds. Both property and alternatives reduced slightly over the period, even though there was some investments in this area, but this is just a function of the fact that equities were so strong. So next slide, please. Just to illustrate the point I've just made in terms of what the individual contributions were, you can see these figures are in millions. So you can see over that period alone, just the market value of our equities within the fund went up by 2.6 billion over that 12 months. The rest of the asset classes you can see listed there were essentially flat to slightly up. I suppose the only outlier there was property, that is in the main UK property, which, as you can imagine, suffered very severely during the period, particularly the retail sector, which was already experiencing its own issues. But unfortunately, the lockdown, and particularly in terms of the lockdown of the high street, caused property values to fall during that period. But you can see completely and utterly dwarfed by what was going on in global equity markets. So if we can move on to the fund performance, so I'm going to look at this in a couple of different ways, short term and then over the longer period. And I'm going to look at it in terms of the return against the customized benchmark that the panel runs the fund against. But also I'm going to be looking at the wider local government pension scheme universe, which is always interesting to have a look at. But these are our returns, and you can see it was quite spectacular. The fund itself was up 23.2%. The benchmark which the fund is run against was up 21.1%, very strong, but we managed to outperform that. And then the local authority average, the universe of a number of other local authority funds, was also up very strongly, and actually ahead of our benchmark, but behind the West Yorkshire pension scheme for the financial year, which was all very nice to see and very encouraging. Just turning now to some slightly longer term performance, which is obviously for a scheme like West Yorkshire. Next slide, please. And next slide, please, Stuart. Not too sure if Stuart can hear me. Could we have the next slide, please, Stuart?
Hi, apologies, Mark. I've moved it forwards on my display. I'm not sure if yours isn't just updating, perhaps.
Oh, okay. Right. Well, I'm not too sure what other people can see, but I'm certainly looking at the. I will carry on as if it is the next slide. So the next slide looks at the return of the fund against its benchmark over a period of 1, 3, 5, and 10 years. You can see that over all those periods, the West Yorkshire pension scheme has beaten its customised benchmark, and in the case of last year, in a very healthy fashion. But it's certainly a real testament to both the internal team and the investment panel, the extent to which that has happened. it is now updated at my end. Can we have the next slide, please, now, Stuart? The one about against the universe. I'm not too sure, is that there yet?
That should be showing to the audience, Mark.
It is good. Right, I can now see this. So this is just another way of looking at performance. So the previous slide was against our own benchmark. This is against the local authority average, and it's over a slightly different time period: 1, 3, 5, 10, and 20 years. And you can see that over 1 year, the fund has done very well, and over 20 years, the fund is definitely above the local authority average. But that middle period we can see is a little bit more mixed, where the blue bars, which is the average, are slightly in excess of the orange bars, which is the West Yorkshire scheme. And I'm going to come back very briefly as to why I believe that is the case just in a while. But before I move on, could I have the next slide, please, Stuart? I'm assuming it's up there. So the next slide that I have on my deck here is the long-term performance of the fund against CPI inflation. And I think one of the most startling things looking at this is the extent to which the asset return of the West Yorkshire pension scheme has absolutely been of orders of magnitude higher than the CPI inflation. And I think that's something that is a real credit both to the team internally, but also really a good advert, I think, for funded schemes. The ability to be able to generate returns way in excess of inflation during this period, and it's certainly been a tremendous achievement. I'm still on the yes. So the next slide, please, Stuart, and then move on to the next slide. So what I'm going to do now is just quickly round back to some observations on that performance. I said I would do that because I just wanted to cover off a couple of issues. So the next slide, which is going to be provided to you, it was from a presentation given to the investment panel by a company called PIRC LAPA. They are the people who put together the local authority universe and provide essentially that data for those figures that we use. And you can see that the chart here, I hope it's in front of you, it's not in front of me, is to show the West Yorkshire pension scheme over sort of 3, 5, 10 and 20 years, and showing the rankings against that universe. And you can see that in the periods 3, 5 and 10 years, the red dot, which represents the West Yorkshire pension scheme, actually sits there below the midpoint. There's 4 different colours of blue rather unhelpfully on this chart, but they represent the quartiles of the universe. And you can see that in periods up to 10 years, that red dot sits slightly below the average, and the rankings sit below the chart. Over 20 years, the fund is very, very slightly ahead. So I thought I'd try and look into perhaps what's going on there, because we know we've beaten our own index benchmark very handsomely. What's going on here? So the next slide, please, Stuart. So we were also presented by the same company, PIRC LAPA, with the relative total equity returns of the West Yorkshire pension scheme against that universe. And what we can see here that in all the individual years from 1970 to 2021, the bars are below the line. That means the return of the equities within the West Yorkshire scheme were underperforming the return to equities in the universe. And actually you can see that over 10 years, the fund's ranking is quite close to the sort of 100 percentile position, which is right towards the bottom. So what is going on here? What we know that equities have done well, we know that, and we know that the West Yorkshire pension scheme has a lot of equities. So what is actually driving this differential, should we say, in returns? And I think that can be explained on the next chart, please. So what this chart shows, I don't have it in front of me, but hopefully you do, is basically the split between UK shares and global shares. And you can see here that I put the split of the universe, the local government universe, and I put the split of the West Yorkshire pension scheme. And you can see there's a very large difference in terms of the ratio of UK companies and shares to overseas shares between the two, between ourselves and the universe. And that really, in a nutshell, is what's gone on here. The UK equity market, even before the run up to the 2016, certainly the 2016 Brexit referendum caused real problems in equity markets and the currency to sell off. But even before that, in fact, ever since the great financial crisis, the UK equity market has been underperforming, and particularly it's been underperforming the US market, which has been extraordinarily strong since 2008. And it really is that differential between our ratio of UK equities and overseas equities that explains that underperformance against the benchmark. Next slide, please. So one of the things the investment committee has decided to do, we've had a significant review of our asset allocation. This is where we currently stand. You can see that we've got more equities than the universe by quite a lot. That has done us quite well, but we've also noticed that the ratio is a bit strange as well. So because the fund is in such a extraordinarily healthy position, as Rodney has mentioned, with more than fully funded, the committee has the really good position to be able to look to diversify some of that equity risk away from the UK equity market and equities in general. And so if you can go on to the next slide, you will see this is where we're aiming for. So that is a reduction in 10% of our equity positions relative. So that will actually put us temporarily slightly below the universe, but in many ways essentially in line. Almost all that reduction will be coming out of UK equities, which will change the ratio, and then the rest of that money will be invested into bonds, alternatives, and to increase our property allocation over the next 5 years. And I think that's going to be quite a big theme for us going forward, this reduction in risk from equity and a movement into some of the other areas we can invest in. So just coming to the end of what I was going to say, next slide, please. Just to bring you absolutely up to date. Next slide, please. So all the figures I've been talking through and Rodney has been talking through were all up to the end of the financial year, which is in March. But obviously we've had quite a period since then as well. So these are the figures I can show you, assuming you're looking at that slide, which is the next one along. Shows the value of the fund up to the end of September. That's the latest values we have. As you can see there, it's a figure which I believe is the highest value the West Yorkshire scheme has ever had, at £17.3 billion, with a further £1 billion worth of market gains earned just in that 6-month period from the end of the financial year to the 30th of September, which, as you can see, is a tremendously strong position to be in. And if we can move forward now to my final thoughts, please.
The audience should be able to see them.
Okay, thank you. So with that bearing in mind, that tremendously strong 17.3 billion value for the fund, the panel has a number of different things to look at. I've mentioned this strategic asset allocation review. That is the one that is reducing equities and reducing the proportion of UK equities in particular. That's going to be going forward over the next years. There is a major topic going on within the panel in terms of our ethical and our ESG and responsible investing agenda. And our responsible investing officer has been recruited. There is major documentation being considered by the panel tomorrow in terms of our ethical and responsibility investing policies, and continual collaborative work with a number of organisations, including LATF and Climate 100. The fund is also seeking to become a signatory to the UK Stewardship Code. I would have to say that probably in terms of agenda, the sort of ethical and responsible investing and climate change agenda is, I would say, probably second to none now in terms of the work of the committee. Just a further three things just to round off. There will be, I think, a growing economic risks, including interest rate rises, that we'll have to look at possibly in the next year. I've already mentioned inflation, and I probably don't need to mention that to anyone who had to fill up their car recently or looking at their growing gas bills. But there's a real inflation issue beginning to develop, I believe, and it's something that will affect investment markets. But we're in a very strong position, and we're going to be looking to identify many new opportunities, particularly away from equities, in the future. And that, without further ado, was all I was going to say. Thank you very much for listening.